Hello everyone. Welcome to video 7 for chapter 6. In this video, we're going to talk about automobile costs. The struggle with automobiles is it's often something that's very expensive on the upfront, but cars have a range of nicety. Businesses need to get from point A to point B, but buying a luxurious vehicle would be for the benefit of the driver, not for the business. So the government has a lot of rules in trying to sift through what's reasonable for expense and what's not. So let's go into those automobile related costs. So the CRA has restrictions on CCA, which we talked about in chapter 5. If it's an automobile that's more than $38,000, you can only capitalize up to $38,000. So a $60,000 car will ever really fully expense 38,000 of it. So we have a limitation saying that car's too expensive. There's a luxury portion to it. But CCA is not the only cost related with owning the vehicle. There's also, what if I don't buy the vehicle, instead I lease it? Well, what's a reasonable and unreasonable lease payment? If I finance the car, a very expensive car is going to have a very large loan, so the interest charge can be quite high. So what's a reasonable interest rate? There's a lack of symmetry that applies to the employer and there's a lack of symmetry applies when employer makes an employer-owned or leased automobile available to an employee, especially if they use it for personal use. In chapter 3, we talked about the standby charge and the operating benefit. If I work for a company and they give me a vehicle that I can drive around for business and for my personal use, I benefit from a portion of the cost of that vehicle. That benefit is 100% included in my income. So, at the regular standby charge is 2% per month. If I drive that car for 50 months, just over 4 years, that entire value of the car, 100%, will have been included in my income. However, if that car is $60,000, the business will only have deducted through CCA maximum 38,000. So the full 60,000 will have been included in my income, but the business didn't get the full 60,000 deduction. So this is called an asymmetrical treatment. Calculation of taxable benefit is based on the actual cost of the vehicle. Employer expenses are restricted if luxurious or restricted from the luxury portion. If it's owned by the taxpayer, this is very straightforward. We already discussed the CCA limitation. They can only capitalize the prescribed amount. Regular class 10.1, it's 38,000. If it's an electric or hybrid vehicle, you can go up to 61,000, recognizing that those types of vehicles are more expensive and there's more incentive to try and use green energy. Keeping the simple rate of 10.1 for $38,000. If it's a luxurious item, there's going to be an interest portion if I'm financing that purchase. So they have a limitation saying the interest can't be more than $11.67 per day. This is actually based on a formula. The formula is $350 per month, which when you calculate that out comes to about $11.67 per day. So what it is once you finance the vehicle, you will accrue, I guess, you will look at the interest paid for the year. And if it's less than 11.67 per day, fully deductible. If it's more than $11.67 per day, then you're limited to that maximum interest rate. Yeah, so let's go right to the exercise for owned automobiles, because that's the simple one. On October 1st, Miss Gabriela Domofsky purchased an automobile to be used exclusively in a business she carries on as a sole proprietor. The automobile is class 10.1. Business commenced September 15th. The cost of the automobile was $90,000. We're going to ignore sales tax. $90,000. She finances a part of the purchase and, as a consequence, incurred interest expense from October 1st to December of $1,500. So she paid $1,500 in interest. Can we deduct the full amount? In calculating the business income, how much can Ms. Domofsky deduct as interest expense related to the automobile? So the question's only asking about the interest, but I'm going to go through both of these expense limitations. The CCA on the vehicle, it maxes at 38,000. So even though the car, the acquisition amount was, sorry, the car cost $90,000. So let's make this $90,000. So the car costs $90,000, but it doesn't matter. The business can only capitalize 38,000. The CCA rate, I'm just going to bring up a calculator. So 38,000 was put into 10.1. The CCA rate at 30% was 11,400. So that's how much we can deduct this year for CCA, except the business started September 15th. So the business only existed for 108 days. So times 108 divided by 365. We're going to take the portion of the year that the business existed. So that 11,400 of CCA gets reduced to 3,373. There it is. So there's the CCA related to the vehicle. This relates to chapter 5, so hopefully I didn't lose anyone through that example. Now we take the lesser for interest, the amount we actually paid, which the question says $1,500, or 1167 per day. So the loan started on October 1st. From October to the end of December, that's only 92 days. 92 times 11.67 per day, we have a maximum expense of 1,073.64. Let's just round to the nearest dollar, 1,074. So this car is providing us a deductible CCA of 3,373 plus the allowable portion of our interest, which is 1,074. The question specifically asked the interest portion, so I've highlighted that number so you see where it comes from. But in total, almost $4,500 of expense this year relates to that owned vehicle. Now let's jump in and go over leases, because leases are a touch more expensive. Not expensive, sorry, a touch more complicated. So automobile leasing costs, this applies to both types of vehicles, 10.1 and Class 54. We're limited to a prescribed lease rate of $1,100 per month. So this is if the lease is entered to within 2025. The prescribed rate changes from year to year. Last year it was 1,050 in 2024. So so if you lease the vehicle in 2024, you're locked in to 1,050 being your maximum deduction for the entire length of the lease. So in a couple years ago, it was only $900. So if I have a lease this year that I started a few years ago, even though that lease payment might be $1,000 within the threshold of this year, it's limited to that $900 from when I entered the lease. So the date the lease is entered into is used to establish the prescribed amount that applies to that lease for its entire term. So right now it's $1,100. The deductible amount of the lease is the smallest of three payments or three calculations. The actual amount paid, the amount determined by the basic cumulative formula. The cumulative formula is using that monthly rate and seeing, okay, so if you're allowed $1,100 per month, how much have you pretty much paid so far? So if my actual amount of lease payments are $900, then this calculation is going to be smaller than the cumulative formula. The reason it uses the cumulative formula is basically just trying to convert lease payments to a monthly rate, because not all leases are monthly. If I have a lease that's weekly or bi-weekly, or maybe I pay once every 6 months, it's hard to say what the monthly amount is, or at least it has to be corrected back to that monthly rate. So the cumulative formula takes how much have you paid, and then it converts it to, or I guess, what's the monthly equivalent time to have passed, and it applies that limit rate. This is going to be very obvious once you see it in play. But both of these are just based off the lease payments. It's not looking at the actual value of the car. So what if we have a luxurious car? but by modifying our lease structure, we've gotten the payment to be very low. So there's a third formula that's called the anti-avoidance formula that looks at the actual value of the vehicle to determine if there should be a limitation placed on the lease payments. So the basic cumulative formula takes A, which is our prescribed rate, right now it's $1,100, times B divided by 30. So B takes the number of days from the beginning of the term to the end of the taxation year. So B is the number of days. So if we signed the lease 2 years ago, that's 700 days. Let's say 700 days ago. So it takes that total number of days and divides it by 30 to get an equivalent number of months. Okay, 700 days divided by 30 is just over 23 months. So we say, okay, so 23 months have passed times $1,100. You should have paid just over 25,666. So we might have paid that amount weekly or biweekly or once or every other month. Whatever our actual lease payment schedule is, doesn't matter. This calculation corrects it to a monthly rate. So if I've paid $25,000, then I'm within my monthly rate of $1,100. But how much can I deduct this year? So this calculates the full amount of the lease payments minus C. C is the total amounts that have already been deducted in previous years. So of this 25,666, they say, okay, well, I've already deducted $15,000 last year, so only the $10,000 left can be deducted this year. So this prescribed rate, this prescribed monthly rate times the equivalent number of months gives us the maximum expense we can declare minus the expenses we've already declared and what's left. Minus D and E are small notational amounts. So D is a small amount of interest. This course is not going to throw those amounts at you. So focus on that ABC. And E is any amounts that have been reimbursed or refunded. You can only claim an expense if you're actually out the money. So if the lease company says, hey, you signed this lease, we'll give you back $2,000 in upgrades or maybe some sort of an allowance. Or maybe you traded in a prior lease, so they gave you some money back. Those reimbursements get subtracted from the basic formula. Like I said, we don't want to complicate it for you guys too much, so I don't think our questions include D&E. So focus on prescribed rate times equivalent number of months minus any expenses already deducted from taxes. Yeah, so this Tax Act Section 67 limits the monthly lease payments to a maximum. Right now it's $1,100. Last year it was $1,050. Then it was $950. In 2022, $900. Before that, $800. So every year this amount kind of gets increased. The prescribed amount for the year is locked once you sign the lease for the entire term. The components of the formula are cumulative from the beginning of the lease. I think the cumulative formula sounds complicated, but it's pretty straightforward. If you have a monthly lease, this B over 30 is very easy to calculate. I've had the lease for 8 months, my prescribed rate times 8 months. The anti-avoidance formula is slightly more complicated because what this is doing is this looks at the value of the vehicle. The formula is necessary to prevent structuring a lease to reduce the impact of the limitation by extending the lease term. Let's say I get a nice car and my monthly lease payment is $1,500, but that's more than what I'm allowed. I'm only allowed $1,100. So I say, hey, instead of a 4-year lease, let's make the lease 6 years or 8 years. By extending the lease term, that monthly payment gets smaller. So I say, okay, let's make the lease 8 years and I'll put $1,000 down. Well, now my lease payments is now 10,000 or 1,070. Now I'm under that 1,100. Boom. I can now deduct the full amount. I have the same car and it's now fully deductible. So the government doesn't want you to be able to reach those limited monthly rates just by changing up the details of your lease, so whether extending the term, requiring a repurchase at the end of the lease, paying a large upfront amount. So the anti-avoidance formula ignores the lease structure and looks at the actual price of the vehicle. So the formula is this. A is the total lease charges you have paid. And then B is the prescribed amount, 38,000 for class 10.1 or 61,000. For this course, let's focus on the 38,000. C is the prescribed amount of 44,706 or the manufacturer's list price. So it uses the larger number. Why do we use 44,706? If we take 44,706 and put that our C, now that C is multiplying by 85%. So times 0.85, that brings us back to our prescribed rates. When you lease a vehicle, it's often more expensive because there's a profit portion that's built into those lease payments. So it's not so simple to say, oh, leased vehicles, we'll just still use the 38,000. It kind of allows for this 15% profit margin to be embedded into the lease amount. So it takes the market value of that lease, 44,706, and brings it back. And now our denominator is 38,000. So if our numerator is 38,000 times our denominator of 38,000, that's 1. Anything times 1 is itself. So as long as the cost of the vehicle is below 44,706, this calculation's going to equal our lease charges, which means there's no modification on our leases paid. If it's more, so let's say we use $96,000. So if the cost of lease is 96,000 times 0.85, well, now that denominator's 81,600. So $38,000 divided by 81,600. So that's 46.56. So basically it's saying about 46% of the lease payments are related to that allowable portion, that allowable 3,800. So if our lease payments totaled $10,000, we can only deduct 4,656. So it's trying to figure out what portion of the lease payments relate to a luxurious aspect. So even though our lease payments for $10,000 for the year divided by 12. So even though our lease payments were $833, meaning it was below our 11,000 maximum, because the car was so valuable, it's reduced the deductibility of those lease payments. Again, it includes D and E, which is notational amount of interest and any amounts reimbursed, but I don't think we're going to complicate it that much. Just focus on that A, B, and C. So the exercise for that is on August 1st, Mr. Sadim Humiz leases an automobile to be used 100% of the time for business as a sole proprietor. The business uses a calendar-based fiscal year, so we're going from August 1st to December 31st. The monthly lease cost is $985. Manufacturer's suggested list price is $78,000. Mr. Humiz makes no down payment and no refundable deposits. Determine the maximum deductible lease. So our lease limits are 3. The first one is always how much did you pay? So $985 from August to December is 5 months. We've paid $4,925. That's how much we've paid in lease payments. Our prescribed rate, $1,100 times 5 months, is about 5,500. I think this will be slightly adjusted in the solution for number of days, but it's going to be close to that $5,500. So that's more than the amount paid. That insinuates that 4,925 is allowed to be deducted. The amount we paid is below our cumulative limit. But the value of that car is very high, $78,000. So 78,000 times 0.85, sorry, 78,000 times 0.85 is 66,300. So this becomes our denominator in that anti-avoidance formula. 38,000 divided by 66,300, we can only deduct 57% of our lease payments that we've made. We already calculated that we paid 4,925. There it is down here. So our anti-avoidance formula says of the amount we've paid, we can only deduct 2,822. We'll round it to 823. So yes, that 425 is below our cumulative formula, so it's allowed, but our anti-avoidance formula says yes, but the car is still too valuable. It's too luxurious, so we're going to portion that paid amount. You can only deduct 28,223. So going to that exercise, we have our three calculations here. This calculation used last year's number, 1050, so 1100. So yes, 4925 is our paid amount. Our actual basic formula is 5,610, just over that 55, because it didn't use just 3 months. It's actually 153 days. So 153 divided by 30 is 5.1 months is the calculation. So our cumulative formula says, well, we could have deducted 5610, but that's above our 4925. So we're limited only by the anti-avoidance formula, which does the calculation, says 2823 is the maximum deduction. Just to finish off the lease conversation, so leasing property, from an accounting standpoint, if the terms of a lease are functionally the entire cost of the asset or property, you have functionally purchased it. The lease structure is more of a financing solution than an actual rental agreement. So accounting standard requires some leases to be recognized as a sale by lessor and purchase by lessee. This does the idea of an economic substance of long-term leases. This is also called a capital lease for accounting standpoint. I don't know if you guys will have done that yet, but for those who have, you will have seen this before. The thing about tax is tax does not recognize capital leases. A lease is a lease is a lease. So whatever those lease payments are, that's what's going to be deducted from your taxable income. An elective provision allows parties to lease to elect to treat lease as if purchase of property. So there is an elective for capital leases, but in my experience, most businesses just allow the lease payments to be deducted because if you do this election, now you're restricted by CCA, not just the lease formulas. So there is an exercise on it, but I'm just going to show you. A lease term from an accounting treatment is looking for substantially all. The guess is the general guideline is about 90%. So if the lease term is 10 years, but this piece of property is only going to last 11, your lease is basically covering the term of its economic life. You're using substantially all of its life. So that is a recorded lease we would recognize as an asset on our financial statements. But the tax treatment, all those payments are just deducted as an expense. Payments are recorded as income, and it's always treated as an operating lease. Okay, that's probably long enough for this video. When we come back, what's next in our slides? Oh, yes. Once we come back, we'll discuss additional details related to expenses for taxation and discussing our business calendar year. All right, thank you for your time. See you in the next video.